There's a thread making waves in crypto Twitter right now. A well known investor named Justin Bonds just published what might be the most detailed breakdown I've seen of Bitcoin's long term security problem. And Ben, he's not mincing words. He's calling for a collapse within 7 to 11 years.
Yeah, I saw this. And here's what's interesting. Whether you agree with his timeline or not, the underlying math isn't controversial. This is a known issue that Bitcoin developers have been quietly discussing for years. The question isn't whether Bitcoin has a security problem. It's whether the community can solve it before it becomes critical.
So let's break this down for people who maybe haven't thought about Bitcoin security in detail. What exactly is the problem here?
Okay, so Bitcoin security comes from miners, people running specialized computers that validate transactions and secure the network. These miners get paid in two ways: newly minted Bitcoin, which we call the block subsidy or inflation reward, and transaction fees paid by users.
And the block subsidy gets cut in half every 4 years, right? The halving events?
Exactly. Every 210,000 blocks, roughly 4 years, the reward drops by 50%. We just had one recently where it went from 6.25 Bitcoin per block down to 3.125. Eventually, by around 2140, it goes to essentially zero. The idea was always that transaction fees would take over as the primary incentive.
But that's not happening.
Not even close. Right now, according to Bond's analysis, transaction fees make up only about $0.14 billion annually, compared to $16.42 billion from the block subsidy. That's less than 1% of miner revenue coming from fees.
So when people say Bitcoin's security is at an all-time high because hash rate keeps going up, they're confusing hash rate with security budget. This is actually a really important distinction. Hash rate measures how many hashes per second the network is computing. But what actually secures Bitcoin isn't the number of hashes, it's how much it costs to produce those hashes.
Can you explain that? Because I think a lot of people assume more hash rate equals more security.
Think about it this way. Let's say it costs $100 million per day to run all the mining equipment securing Bitcoin today. That's your security budget. That's what an attacker would need to match or exceed to take over the network. Now, if mining hardware gets twice as efficient next year, you might see hash rate double while the actual cost to run that equipment stays the same or even drops.
So hash rate goes up, but the real economic barrier to attacking the network doesn't.
Exactly. And here's where Bond's math gets uncomfortable. He calculates that after 3 more halvings, so in about 11 to 12 years, the daily cost to attack Bitcoin for one day could drop to around $2.88 million. That's not theoretical Bitcoin price appreciation, that's just the math of the halvings, assuming price and fees stay relatively stable.
And why is $2.88 million significant?
Because the profit from successfully attacking Bitcoin is potentially massive. If you can execute what's called a 51% attack, controlling more than half the mining power, you can double spend coins, send Bitcoin to an exchange, trade it for cash or another asset, withdraw that, then rewrite the blockchain to undo your original Bitcoin transaction.
So you end up with both the Bitcoin you sent and whatever you traded it for.
Right. And you could hit multiple exchanges simultaneously. Bonds estimates you could extract $100 million or more per exchange. So you're looking at a scenario where spending a few $1,000,000 per day could net you hundreds of millions in profit.
That's a pretty terrifying ROI for an attacker.
It gets worse when you think about state actors. China attacking a U.S. Bitcoin reserve, as Bonds mentions, might not even be about profit. It could be strategic. Spend $1 billion to destabilize a $2 trillion asset that your geopolitical rival is holding.
Okay, so that's the security crisis. But Bones also talks about something he calls a bank run scenario. What's that about?
This is where Bitcoin's limited capacity becomes a real problem. Bitcoin can process about 7 transactions per second under ideal conditions. That's 604,800 transactions per month.
That seems low.
It's extremely low. According to data from 2023, there were about 33 million on-chain Bitcoin holders. If each of them tried to make just one transaction to move their Bitcoin, the queue would be 1.82 months long. And that's a conservative estimate from 3 years ago. There are likely more holders now.
But it's not really a queue, right? It's a fee market. If you pay more, you get in faster.
Yes, but there's a ceiling. The network can only process so many transactions per block, period. So if millions of people are trying to exit at once, paying higher fees doesn't solve the fundamental capacity problem. Most transactions would just fail to confirm. They'd sit in the mempool for days and eventually drop.
So even if you're willing to pay, you might not be able to move your Bitcoin.
Exactly. And this creates a potential death spiral. Imagine some event triggers panic. Maybe the security budget drops low enough that a medium-sized attack succeeds. People rush to sell, the price drops. When price drops, mining becomes less profitable, so some miners shut down. When miners shut down, the network gets slower because Bitcoin's difficulty adjustment takes 2 weeks to kick in.
Wait, the network gets slower when miners leave?
Yeah, this is a quirk of Bitcoin's design. The difficulty adjustment is measured in block time, not wall clock time. So if half the miners suddenly disappear, blocks that should take 10 minutes might now take 20 minutes. And the adjustment that would fix this, that normally happens every 2 weeks, now takes 4 weeks because you're producing blocks at half speed.
So the congestion gets worse, which causes more panic, which drops the price further, which shuts down more miners.
And you spiral. Bonds calls this the death spiral scenario. A 3-month backlog turns into 6 months, then a year. The network effectively stops functioning for regular users.
This sounds apocalyptic, but Bitcoin has been around for 15 years. Why hasn't this been addressed?
This is where it gets political, and honestly, this is the most interesting part of Bond's argument. He goes deep into what he calls the block size wars.
I remember hearing about this, but I never understood what actually happened.
So, Bitcoin's creator, Satoshi Nakamoto, originally envisioned Bitcoin scaling to handle massive transaction volume. There are quotes from Satoshi saying Bitcoin could already scale larger than Visa with existing hardware. The plan was always to increase the block size as adoption grew.
But that didn't happen.
No. Around 2015 to 2017, there was a massive civil war in the Bitcoin community. One side wanted to increase the block size to allow more transactions. The other side, led by the Bitcoin core development team, wanted to keep blocks small and push transactions onto second-layer solutions like the Lightning Network.
And Core 1.
Core 1. They implemented something called SegWit, which gave a small capacity boost, but they never increased the actual block size limit. And according to Bonds, this was a fundamental betrayal of Bitcoin's original vision. He argues that the people who wanted bigger blocks, including prominent developers like Gavin Anderson and Mike Hearn, were essentially pushed out.
So the governance centralized around Bitcoin Core.
That's Bond's argument. He calls it a GitHub dictatorship. Right now, only 6 people have commit access to the Bitcoin Core repository. And while there are processes and discussions, Bitcoin Core effectively controls what changes get implemented.
But couldn't someone just fork Bitcoin and increase the block size?
They did. Bitcoin Cash, Bitcoin SV, these were forks that increased block size, but they lost the network effect battle. The Bitcoin brand, the ticker symbol BTC, the hash rate, the exchanges, all stayed with Bitcoin Core's version.
And now Bond says trying to create a competing client is seen as an attack on Bitcoin.
Right. The culture has shifted. During the block size wars, there was significant support for increasing capacity, but the people who supported that change mostly left the Bitcoin community. The demographics self-selected. Now you have a community that largely opposes major protocol changes, and there are entrenched economic interests, Lightning Network businesses, Layer 2 companies, that benefit from Bitcoin's base layer staying constrained.
So even if the security crisis becomes obvious, the governance structure makes it almost impossible to fix.
That's the pessimistic view. Bonds argues there are only 2 options when the security budget gets critically low: either increase inflation beyond 21 million coins or let the network come under attack. And increasing inflation breaks Bitcoin's core promise.
It breaks the promise that there will only ever be 21 million Bitcoin. Some prominent Bitcoin developers, including Peter Todd, have acknowledged this might be necessary, but it would likely split the community. You'd have one chain that maintains the 21 million cap and accepts lower security, and another chain that increases inflation.
Both which would be weaker than Bitcoin is today.
Exactly. Split the hash rate, split the community, split the value. It's a mess.
Okay, so let's push back on something. Bitcoin maximalists would say, The fees will rise naturally as adoption increases. We'll have billions of dollars in daily transaction fees when Bitcoin becomes the global reserve currency. Is Bonds wrong about that?
Here's the problem with that argument. If fees get extremely high, say hundreds or thousands of dollars per transaction, users just leave. There's a ratcheting effect. Fees spike, users stop transacting, fees come back down. You need sustained high fees, not just occasional spikes.
And we haven't seen that.
We haven't. Even during peak congestion periods, fee revenue is nowhere near what's needed to replace the block subsidy. And that's with 7 transactions per second. If you tried to increase capacity to handle more volume, each individual transaction would generate less fee revenue because supply increased.
So it's a catch-22. Keep capacity low to maintain high fees, but then you can't serve enough users to generate total fee revenue that matches the security budget.
Exactly. Versus the original vision. High volume, low fees per transaction, but massive aggregate fees because you're servicing billions of people.
Which brings us to something I know you've been thinking about. Where does chain key cryptography and ICP's architecture fit into this conversation? Because I assume you're going to tell me Internet Computer solves this.
I'm not going to say it solves Bitcoin's problem because Bitcoin is Bitcoin. It's a separate network with its own community and governance. But I think the security model comparison is instructive.
How so?
Internet Computer uses a completely different security model. Instead of relying on proof-of-work mining where you're burning electricity to produce hashes, ICP uses a proof-of-stake model with something called chain key cryptography. The security budget doesn't depend on inflation at all.
Because stakers lock up existing tokens rather than receiving newly minted ones?
Partially, yes. But more importantly, the cost to attack ICP isn't based on matching miner revenue. It's based on acquiring a supermajority of staked tokens across independent node providers. And those tokens get more expensive as you try to buy them because you're bidding up the price. It's economically self-correcting in a way that proof-of-work mining isn't.
But doesn't proof of stake have its own centralization risks? The rich get richer, large validators control everything?
That's a legitimate concern, and it's why ICP's implementation is worth looking at specifically. Validators on ICP, they call them node providers, have to meet hardware requirements and go through a verification process. You can't just spin up 1,000 virtual servers and dominate the network. There's also a governance mechanism, the network nervous system, that can remove malicious node providers.
So there's a trade-off. You're trusting governance and identity verification to maintain decentralization, rather than the anonymous, permissionless nature of Bitcoin mining.
Exactly. It's a different trust model. Bitcoin says, trust the math and the incentives. Anyone can participate anonymously. ICP says, trust the governance system to select and maintain a diverse set of verified node operators.
And the security budget doesn't decrease over time.
No, because staking rewards can be adjusted by governance. If the network needs more security, you can incentivize more staking. You're not locked into a deflationary emission schedule that was set 15 years ago.
But here's what I'm thinking. Bitcoin's security model was supposed to be its strength. Pure math, no human intervention needed. If you need governance to maintain security, isn't that reintroducing the very centralization Bitcoin was trying to eliminate?
That's the philosophical debate, right? Bitcoin's purity comes from eliminating human discretion, but Bond's entire argument is that this purity leads to an insoluble dilemma. You can't have perfectly predictable issuance, anonymous permissionless mining, limited transaction capacity, and long-term security. Something has to give.
So you're saying proof of stake isn't perfect, but it's adaptable in ways proof of work can't be.
That's my read. And look, ICP specifically has another relevant piece here, which is the reverse gas model. On Bitcoin and Ethereum, users pay transaction fees. On ICP, smart contracts pay for their computation using something called cycles.
How does that help with the fee problem?
It decouples user experience from network congestion. If Bitcoin had a mechanism where applications or services absorb the cost of transactions, you wouldn't see the same fee spikes that drive users away. The economic burden shifts from individual users to the protocols serving them.
But someone still has to pay.
Of course, the protocols pay using cycles, which they purchase with ICP tokens. But this allows for better predictability, and it means the network can still generate revenue even when user-facing fees are low or zero. It's a different economic model.
Okay, but let's be real. ICP isn't challenging Bitcoin for the store of value narrative. Bitcoin has network effects, brand recognition, regulatory clarity in some jurisdictions. Even if its long-term security model is questionable, it's still what institutions are buying.
Absolutely. And that's Bond's frustration. He's not saying Bitcoin will die next year, he's saying there's a structural problem that could cause a crisis in 7 to 11 years, but the governance structure makes it fixing it almost impossible. The political inertia is too strong.
So what happens?
I think there are a few scenarios. One, Bitcoin's price continues to rise dramatically and somehow sustains high enough fees to maintain security. But as Bonds points out, that requires unrealistic exponential growth. Two, the community agrees to increase inflation, which would be a massive philosophical shift and likely cause a chain split. Three, we see a slow decay as security budget drops and smaller attacks start succeeding, gradually eroding confidence.
Or four, someone finds a completely different solution that nobody's thought of yet.
That's always possible. But Bond's point is that increasing block size, the obvious technical solution, is politically impossible because of how the block size wars played out.
There's something kind of tragic about that, like the technical problem has a known solution, but the social and political dynamics prevent it from being implemented.
Welcome to decentralized governance. This is why I think the block size wars are such an important case study. It's easy to say code is law and the community will figure it out. But in practice, power concentrates, narratives solidify, economic incentives entrench, and change becomes nearly impossible.
Even when the math is screaming that change is necessary.
Even then. And that's what makes Bond's timeline claims interesting. He's not just saying Bitcoin has a problem, he's saying the window for addressing it is closing because of how long it takes to shift community consensus and implement major protocol changes.
So you're saying proof of stake isn't perfect, but it's adaptable in ways proof of work can't be.
That's my read. And look, ICP specifically has another relevant piece here, which is the reverse gas model. On Bitcoin and Ethereum, users pay transaction fees. On ICP, smart contracts pay for their computation using something called cycles.
How does that help with the fee problem?
It decouples user experience from network congestion. If Bitcoin had a mechanism where applications or services absorb the cost of transactions, you wouldn't see the same fee spikes that drive users away. The economic burden shifts from individual users to the protocols serving them.
But someone still has to pay.
Of course, the protocols pay using cycles, which they purchase with ICP tokens. But this allows for better predictability, and it means the network can still generate revenue even when user-facing fees are low or zero. It's a different economic model.
Okay, but let's be real. ICP isn't challenging Bitcoin for the store of value narrative. Bitcoin has network effects, brand recognition, regulatory clarity in some jurisdictions. Even if its long-term security model is questionable, it's still what institutions are buying.
Absolutely, and that's Bond's frustration. He's not saying Bitcoin will die next year, he's saying there's a structural problem that could cause a crisis in 7 to 11 years, but the governance structure makes it fixing it almost impossible. The political inertia is too strong.
So what happens?
I think there are a few scenarios. One, Bitcoin's price continues to rise dramatically and somehow sustains high enough fees to maintain security. But as Bonds points out, that requires unrealistic exponential growth. Two, the community agrees to increase inflation, which would be a massive philosophical shift and likely cause a chain split. Three, we see a slow decay as security budget drops and smaller attacks start succeeding, gradually eroding confidence.
Or four, someone finds a completely different solution that nobody's thought of yet.
That's always possible. But Bond's point is that increasing block size, the obvious technical solution, is politically impossible because of how the block size wars played out.
There's something kind of tragic about that, like the technical problem has a known solution, but the social and political dynamics prevent it from being implemented.
Welcome to decentralized governance. This is why I think the block size wars are such an important case study. It's easy to say code is law and the community will figure it out. But in practice, power concentrates, narratives solidify, economic incentives entrench, and change becomes nearly impossible.
Even when the math is screaming that change is necessary.
Even then.
And that's what makes Bond's timeline claims interesting. He's not just saying Bitcoin has a problem, he's saying the window for addressing it is closing because of how long it takes to shift community consensus and implement major protocol changes.
So you're saying proof of stake isn't perfect, but it's adaptable in ways proof of work can't be.
That's my read. And look, ICP specifically has another relevant piece here, which is the reverse gas model. On Bitcoin and Ethereum, users pay transaction fees. On ICP, smart contracts pay for their computation using something called cycles.
How does that help with the fee problem?
It decouples user experience from network congestion. If Bitcoin had a mechanism where applications or services absorb the cost of transactions, you wouldn't see the same fee spikes that drive users away. The economic burden shifts from individual users to the protocols serving them.
But someone still has to pay.
Of course, the protocols pay using cycles, which they purchase with ICP tokens. But this allows for better predictability, and it means the network can still generate revenue even when user-facing fees are low or zero. It's a different economic model.
Okay, but let's be real. ICP isn't challenging Bitcoin for the store of value narrative. Bitcoin has network effects, brand recognition, regulatory clarity in some jurisdictions. Even if its long-term security model is questionable, it's still what institutions are buying.
Absolutely, and that's Bond's frustration. He's not saying Bitcoin will die next year, he's saying there's a structural problem that could cause a crisis in 7 to 11 years, but the governance structure makes fixing it almost impossible. The political inertia is too strong.
So, what happens?
I think there are a few scenarios. One, Bitcoin's price continues to rise dramatically and somehow sustains high enough fees to maintain security. But as Bonds points out, that requires unrealistic exponential growth. Two, the community agrees to increase inflation, which would be a massive philosophical shift and likely cause a chain split. Three, we see a slow decay as security budget drops and smaller attacks start succeeding, gradually eroding confidence.
Or 4, someone finds a completely different solution that nobody's thought of yet.
That's always possible. But Bond's point is that increasing block size, the obvious technical solution, is politically impossible because of how the block size wars played out.
There's something kind of tragic about that. Like, the technical problem has a known solution, but the social and political dynamics prevent it from being implemented.
Welcome to decentralized governance. This is why I think the block size wars are such an important case study. It's easy to say code is law and the community will figure it out, but in practice, power concentrates, narratives solidify, economic incentives entrench, and change becomes nearly impossible.
Even when the math is screaming that change is necessary.
Even then. And that's what makes Bond's timeline claims interesting. He's not just saying Bitcoin has a problem, he's saying the window for addressing it is closing because of how long it takes to shift community consensus and implement major protocol changes.
Do you think he's right about the timeline? 7 to 11 years?
I think he's identified a real issue, and the math is directionally correct. Whether it plays out in exactly 7 to 11 years depends on a lot of variables. Bitcoin's price trajectory, fee market dynamics, technological improvements in mining efficiency, whether any successful attacks happen earlier that trigger panic.
The bank run scenario.
Right. If there's a triggering event before the security budget gets critically low, maybe a medium-scale attack that succeeds, or just widespread realization of the problem, you can see the death spiral happen earlier than the math predicts.
Because human psychology is faster than halvening schedules.
Exactly. Fear and panic don't wait for the next difficulty adjustment.
So what should people actually do with this information? If you're holding Bitcoin right now, do you sell?
I think that's a personal risk tolerance question. Bonds is clearly saying yes, he's exited his Bitcoin position. He's been vocal about moving to other cryptocurrencies that he believes solve these problems, probably Bitcoin Cash or similar projects, though he doesn't specify in this piece.
What about institutional investors? They're not going to exit based on a Twitter thread.
No, but they should be asking these questions. If you're a nation-state building a strategic Bitcoin reserve, you should have a team modeling out these scenarios. What happens in 2035 when the block subsidy is 0.78125 Bitcoin per block? What's your exit strategy if the security budget drops to concerning levels?
And I imagine their answer is, Bitcoin will be worth so much more by then that the security budget in dollar terms will still be massive.
That's the optimistic case, but it requires Bitcoin to appreciate about 16x from current levels just to maintain the current security budget after the next 3 halvenings. That's aggressive.
Especially if the appreciation is driven by institutional adoption, but those institutions start having concerns about long-term security, which could cap appreciation, which makes the security problem worse.
Now you're thinking like a game theorist. It's a reflexive problem. Expectations about future security affect current price, which affects future security budget.
Okay, last question. If this is a known problem and you're saying Bitcoin developers have been discussing it quietly for years, why isn't there more public debate about solutions?
There is, but it happens in technical spaces. Developer mailing lists, academic papers, small conferences. It doesn't make it to mainstream Bitcoin discourse because a community is invested in the narrative that Bitcoin is perfect as is. Any suggestion that Bitcoin needs fundamental changes gets labeled as FUD or a tax.
Even when it comes from prominent developers.
Even then, Peter Todd can say we might need to increase inflation and he'll get pushback. The culture has evolved to treat Bitcoin's current implementation as sacred. Ossification, the idea that Bitcoin's protocol should freeze and never change, is seen as a feature, not a bug.
So, ossification before solving the security budget problem means you're ossifying the problem.
That's Bond's argument. He's saying Bitcoin's governance failed at a critical moment during the block size wars, and now we're locked into a trajectory that leads to a predictable crisis.
And the people who could fix it either don't have the power or don't have the political will.
Or both. The 6 people with commit access to Bitcoin Core could technically propose changes, but they'd need overwhelming support to implement something as dramatic as increasing the block size or changing the emission schedule, and that support doesn't exist.
So we watch and wait.
We watch and wait, and maybe Bonds is wrong. Maybe fees surprise everyone and rise to sustainable levels. Maybe Bitcoin's price goes on an unprecedented run that solves the security budget through sheer appreciation. Maybe some technological breakthrough changes the calculus entirely.
But if he's right,
then we're looking at a crisis in Bitcoin's second or third decade that could shake the entire crypto ecosystem, because Bitcoin is still the flagship. It's what regulators focus on, what institutions trust, what the media covers. If Bitcoin has a major security failure, the contagion effects across all of crypto could be severe.
Which is why this matters even if you don't hold any Bitcoin.
Exactly. This is a systemic risk question, and I think Bonds is doing the community a service by laying out the math clearly, even if people don't like the conclusions.
Even if it hurts his own investments in the short term.
Well, he's clearly moved his investments elsewhere. But yeah, going public with this kind of analysis takes courage because you're going to be attacked by Bitcoin maximalists who see any criticism as heresy.
I've already seen the responses on Twitter. Lots of people calling him a shitcoiner, saying he doesn't understand Bitcoin, claiming the market will solve it.
The market will solve it by repricing Bitcoin's value to reflect its actual long-term security model. That's a solution, but not one current holders will like.
Brutal but fair.
Look, I have respect for what Bitcoin has accomplished. It created an entire industry. It proved that decentralized digital scarcity was possible. But that doesn't mean it's perfect or that we should ignore fundamental problems in its design.
Especially problems that were introduced by human decisions, not mathematical necessity.
Right. The 1 megabyte block size limit wasn't in Sasidi's original code. It was added as a temporary anti-spam measure and then turned into a permanent constraint during the block size wars. We made this problem through governance choices.
So, in theory, we could unmake it through different governance choices.
In theory. But Bonda's argument is that the political economy of Bitcoin makes that practically impossible now. The people and institutions that benefit from the status quo are too entrenched.
Layer 2 companies, miners who benefit from high fees, maximalists who've built their identity around Bitcoin's current form.
All of those. Plus you have nation-states now holding Bitcoin as a reserve asset. Do you think they want protocol uncertainty? El Salvador made Bitcoin legal tender. They're not going to support controversial forks.
So the institutional adoption that everyone celebrated actually makes the protocol harder to change.
That's the irony. Success breeds ossification, which prevents adaptation, which could lead to failure.
Where do we go from here? What are you watching for?
I'm watching the fee market. If we start seeing sustained periods where fees make up, say, 20 or 30% of miner revenue, that would change the calculus significantly.
I'm also watching for any successful attacks on Bitcoin or similar proof-of-work chains. Those would be early warning signs.
And governance discussions.
Definitely. If Bitcoin core developers start seriously proposing emission schedule changes, or if we see a credible competing client gain traction, those would be huge signals. Right now, the silence is deafening.
The silence from Bitcoin leadership, but Bonds is making noise.
He's one voice, a knowledgeable, well-researched voice with a detailed argument. But he's fighting against a narrative that's been building for 15 years and is now worth trillions of dollars.
So he's probably going to lose the narrative battle in the short term.
Almost certainly. But if the math is right, reality wins in the long term.
That's not comforting if you're caught holding Bitcoin when reality asserts itself.
No, it's not. Which is why I think diversification across different security models makes sense. Don't put all your trust in one approach, whether that's Bitcoin's proof of work, Ethereum's proof of stake, or ICT's chain key cryptography. Understand the trade-offs of each.
And understand that all of these systems are still experiments.
They are. We're in year 15 of Bitcoin, year 9 of Ethereum, year 4 of ICP in its current form. These are young technologies with long-term questions that haven't been answered yet.
But we're about to find out if Bitcoin's answers hold up.
We are. And whether you agree with Bond's timeline or not, I think he's asking the right questions. What happens when the security budget drops? Can fees realistically compensate? Will the community accept inflation if necessary? These aren't hypotheticals anymore. They're planning scenarios we need to think through.
Especially if you're building businesses or infrastructure that depends on Bitcoin long term.
Exactly. If you're launching a Bitcoin-based financial product today, you should have a risk model that includes security budget drops below sustainable threshold as a scenario. Maybe it's low probability in your model, but it should be there.
And if you're hodler, you should at least understand what you're hodling and what assumptions you're making about the future.
Right. The narrative that Bitcoin is unchanging, perfectly secure digital gold forever, that's a narrative. It's not mathematical truth. There are variables, there are assumptions, there are governance dynamics that could play out in different ways.
And one possible outcome is what Bonds describes.
One possible outcome is what Bonds describes. I don't know if it happens in 7 years or 11 years or 20 years or not at all, but the underlying dynamics he's identified are real, and they deserve serious discussion, not dismissal.
So that's what we wanted to do here. Take the arguments seriously, look at the math, understand the trade-offs, and talk about what it means for the broader crypto landscape.
And acknowledge that different protocols are trying different solutions to these fundamental problems. Bitcoin chose one path, others chose different paths. We'll see which approaches survive.
In the meantime, stay informed, understand the risks, and maybe don't put your entire net worth into any single cryptocurrency.
That seems like reasonable advice regardless of your views on Bitcoin's long-term security.
All right, we'll be watching this story as it develops. Thanks for breaking it down with me, Ben.
Thanks for keeping me honest, Sarah.